Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan, and today we're diving into some crucial topics affecting the real estate and mortgage landscape in Ontario and across Canada. In this episode, we'll cover what the latest CMHC housing survey reveals about Canada's affordability crisis, the recent slowdown in rent growth, and the impact of high borrowing costs and record condo completions in Greater Toronto. We'll also discuss the doubling of mortgage delinquencies in London and the suspension of 2 Quebec real estate brokers for using fake bids to drive up prices. So, let's get started. A growing number of Canadians are feeling the financial squeeze as housing costs continue to rise, according to data from the 2022 Canadian Housing Survey. Conducted by the Canada Mortgage and Housing Corporation and Statistics Canada, the survey sheds light on key housing issues such as affordability, core housing needs, and the impact of rising living costs. In 2022, 22.6% of households reported they often or sometimes face financial challenges due to rising rent or mortgage payments, nearly doubling from 12.2% in 2018. This rise comes against the backdrop of soaring housing costs in many parts of the country. While the majority of Canadians, 77.2%, still say they have not experienced significant financial difficulty due to housing costs, the number of those who are struggling has clearly increased. The survey also found that 11.6% of Canadian households were in core housing need in 2022, meaning they live in housing that is either unaffordable, inadequate, or unsuitable, and cannot afford alternative accommodations in their community. This rate is a return to pre-pandemic levels after briefly dipping to 9.8% in 2021, when emergency pandemic support like the Canada Emergency Response Benefit temporarily eased some financial burdens. Renters continue to be hit harder than homeowners, with 22.1% of renters in core housing need compared to just 6.1% of homeowners. Renters in social and affordable housing face the most challenges, with nearly one-third, 30.8%, in core housing need. For those in core housing need, affordability remains the main issue. According to the survey, 88.4% of households in core housing need reported that unaffordable housing costs were a significant factor. Housing is considered unaffordable if more than 30% of a household's pre-tax income is spent on shelter costs. Other challenges, such as inadequate housing, 16.8%, and unsuitable housing, 9.7%, were less common but still notable. The survey also highlighted disparities among different demographic groups. Racialized households are more likely to experience core housing need, with 14.1% of these households facing housing challenges, compared to 11.6% of all Canadian households. Certain groups, including Black, 18.3%, West Asian, 27.7%, and Korean, 26.9%, households reported particularly high rates of core housing need. Indigenous households faced a higher risk, with 17.9% in core housing need, well above the national average. Canada's rental market is finally seeing a break after nearly 3 years of surging rent prices, thanks to increased housing supply and a drop in demand. Average asking rents for all residential properties across Canada rose by just 3.3% year over year in August, reaching $2,187 per month. This marked the slowest rent growth in almost 3 years, according to the latest national rent report from rentals.ca and Urbanation. On a month-to-month basis, rents dipped slightly by 0.1%, continuing a trend of moderation observed since May. Urbanation President Sean Hildebrand noted, rent increases in Canada finally returned to their longer-term average after nearly 3 years of excessive growth. Hildebrand attributed the cooling of rent growth to more rental units coming on the market and a decrease in demand, partly due to policy changes affecting immigration and population growth. For the last few years, Canada's rental market struggled with a lack of available housing, which pushed up prices, particularly in major urban centers. However, recent increases in construction activity and shifts in population dynamics are starting to relieve some of that pressure. Those looking to share accommodations are also feeling the pinch. Shared rental listings saw an 8% jump in rents, averaging $1,011 in August. although shared accommodation costs dropped in Toronto and Vancouver, with rents falling to $1,234 and $1,181 respectively. Other cities like Calgary, Ottawa, and Montreal saw increases. The report also highlighted differences in how various types of rental properties are faring. Purpose-built rental apartments saw a 6.2% increase, with average rents rising to $2,118. Condominium rentals, however, showed little movement, increasing by just 0.1% to an average of $2,308. Interestingly, while rents for studio condos fell for the sixth straight month, down 3.3% to $118.25, studio rents for purpose-built apartments rose by 10.7% to $1,184. Despite the overall slowdown, certain regions still have notably high rents. British Columbia and Ontario remain the most expensive provinces to rent in, but both saw declines. In British Columbia, average apartment rents dropped by 5.2% year-over-year to $2,536, and in Ontario, they fell by 4.3% to $2,390. Saskatchewan, on the other hand, saw the largest rent increase, jumping 21.4% annually, with average apartment rents hitting $1,338. Among Canada's major cities, only Edmonton experienced rent growth, with rents climbing 9.2% to an average of $1,170. Toronto, traditionally one of the country's most expensive rental markets, saw the steepest decline, with rents falling 6.9% to $2,797. Meanwhile, Vancouver, which had been on a 9-month streak of rent declines, saw its average rent inch back up to $3,116, still the highest in Canada. Next up, let's talk about the recent developments in the Greater Toronto Area's condo market. According to a report by TD economist Rishi Sondhi, we're seeing a significant oversupply of condos in the region, primarily due to high borrowing costs and a surge in new condo completions. Sales activity just isn't keeping up with the new supply. In July, condo resales in the Greater Toronto Area were down 25% from pre-pandemic levels. This trend is influenced by several factors, including the wave of newly built condos hitting the market, elevated borrowing rates making it tough for some buyers to close on their mortgages, and investors looking to offload properties as declining rents and negative cash flow make them unprofitable. Sondhi pointed out that the relatively high interest rates have narrowed the gap between the rate of return from a condo in the Greater Toronto Area and from a risk-free government bond. This reduction in incentive to hold a condo as an investment may be contributing to the oversupply. However, he did mention that the recent drop in yields could help to re-widen this spread. Let's talk numbers. Between January and July of this year, there were around 19,000 condo completions in the region. That's up from about 12,000 during the same 7-month period in 2023 and 10,000 the year before. This pace suggests we could see a record high for condo completions in the Greater Toronto Area this year. Brendan Cowans, a sales representative for Toronto-based brokerages Property.ca, commented on this situation. He said, "You can just imagine all of this supply coming in a high interest rate environment. It's not a lovely combination." Active condo listings across the Greater Toronto Area were up 63.9% in July from the same month last year, growing from 5,416 to 8,879, according to data from real estate firm Zoocasa. The City of Toronto has seen a similar jump, with active condo listings increasing year-over-year by 61.5% over the same period. Although the Greater Toronto Area leads the country in active listings gains, this trend is consistent with other major cities across Canada. Year-over-year active condo listings rose more than 40% in London, Hamilton, Burlington, Mississauga, and Ottawa in Ontario, as well as Vancouver. Montreal and Calgary each saw growth of about 23%. Zoocasa noted that as interest rates have increased over the past 3 years, the cost of holding onto investment properties, like condos, has also increased. Brendan Cowans mentioned, "Some of the carrying costs for these properties, especially for people who bought within the last 5 years and were on variable rates, saw their carrying costs shoot through the roof." For buyers, however, the influx of supply has meant more favorable prices. Condo prices fell 2% year-over-year in July across the Greater Toronto Area, compared with a 1% decrease for townhouses and a 0.1% decrease for detached properties. Condo prices in the region have also declined by around 5% since the third quarter of last year. Sandhi predicted a gradual recovery for sales as supply and demand become more balanced. He forecast that condo resale prices could decline by mid to high single digits through the early part of next year. He did caution that there are risks to the near-term condo price outlook on both sides. On the downside, the wave of condos slated for completion will continue to add to supply. On the upside, condo sales could react more aggressively to falling rates than expected, or investors could pull their properties off the market, tightening conditions faster than anticipated. Earlier this month, the Bank of Canada cut its key lending rate by a quarter percentage point to 4.25%. While that marked the bank's third straight cut, Governor Tiff Macklem cautioned that the pace of those reductions might be adjusted as conditions warrant. Sandhi mentioned that interest rates are likely to remain relatively elevated into 2025 amid continued affordability challenges, thus holding back activity. However, some experts are more optimistic. Debbie Kosich, founder and CEO of Intuition Realty, believes oversupply conditions are temporary. She said, "We're expecting next year to be a very strong year because we believe interest rates will continue downward. For buyers, now might be the time to lock in a purchase and take advantage of incentives being offered." Kosich believes the oversupply is coming from the public, just standing back to see when the market hits rock bottom. She said, "We believe it's hit rock bottom." Cowans also weighed in, saying the number of rate cuts by the Bank of Canada over the next year and a half will be key. He said, "I do see things picking back up in the future. I don't expect it to be super fast. I can anticipate increases as more rate cuts continue to happen. And in 2027, I just think it's going to be madness. If people can hold on for the next 2 years, even 3, it's going to be a drastically different story." The number of Londoners behind on their mortgage payments has doubled in the past 2 years as the burden of higher interest rates overwhelms some homeowners. According to a report from Canada Mortgage and Housing Corporation, delinquency rates, when a homeowner has missed at least 3 consecutive mortgage payments, in London sat at 0.14% in the first quarter of the year, up from 0.07% in the same quarter of 2022. London's rate of increase is similar to the one seen across Ontario, which saw its delinquency rate go up to 0.15% from 0.07% during the same period, Canada Mortgage and Housing Corporation reported. The increases coincide with the Bank of Canada's decision in early 2022 to start raising its key lending rate, which impacts the interest charged on loans such as mortgages and lines of credit, in response to runaway inflation at the time. At 0.14%, London's delinquency rate now matches the level in the area before the pandemic. But more importantly, they are below figures in the early 2010s, when the delinquency rate reached the 0.40% mark, said Anthony Passarelli, Canada Mortgage and Housing Corporation's lead economist for Southern Ontario. It's concerning that the mortgage delinquency rates are on the rise, but they were coming from a very low level because during the pandemic, mortgage rates were at those rock-bottom numbers, he said. But they still aren't anywhere near the levels we've seen historically in London. Last week, the Bank of Canada announced it was cutting its key lending rate for the third time this year, bringing it down to 4.25% from a high of 5%. Governor Tiff Macklem said the decision was motivated by continued progress on inflation and the need for growth to pick up again, making analysts believe more cuts will come later this year. Those potential cuts would bring some much-needed relief to homeowners who bought their properties using variable mortgage rates and who have been hit the hardest by the central bank's previous increases, said Victor Tran, an analyst with Rates.ca. "We're not going to be able to get back to where we were in 2020 or 2021 with the rates at sub-2% levels," he said. "But this will naturally help bring delinquency rates under control because customers that are currently in a variable mortgage will see lower payments as the rates continue to decline." It's a different story for homeowners on fixed mortgage rates, who entered the market during the pandemic, when home prices were through the roof, and are only now up for renewal. According to Canada Mortgage and Housing Corporation, about 2.2 million households, or about 45% of all outstanding mortgages, would be renewing their mortgage in 2024 or 2025. The people that we're speaking about purchased during the pandemic years, so they got into the market at the peak, and prices have now cooled off, Passarelli said. For them, it could be more of a payment shock if they renew at much higher rates. London's unemployment rate, however, represents an even greater threat that could lead to an increase in delinquency rates in the near future, Passarelli said. Locally, the jobless rate for the region, which also includes Strathroy, St. Thomas, and portions of Middlesex and Elgin counties, sat at 6.5% in August. But it has been trending upward during the past year, the result of job losses coupled with strong population growth. When you're losing your job, you just don't have that source of income to be able to cover your mortgages, particularly if you bought at an expensive time and your mortgage is large, Passarelli said. So, an even greater risk to these mortgage delinquencies increasing more than monetary policy is the state of the economy. In a shocking turn of events, 2 Quebec real estate brokers have been handed significant suspensions for their involvement in a scheme that used fake bids to drive up home prices during the COVID-19 pandemic. Christine Girouard has been suspended for 14 years, and her business partner, Jonathan Dauphiné-Fortin, has been suspended for 9 years. This comes after Quebec's Authority of Real Estate Brokerage found they used bogus offers to manipulate buyers into raising their bids. Christine Girouard, a well-known broker who previously appeared on a Quebec reality show that follows top real estate agents in the province, is facing a fine of $50,000. Her business partner, Jonathan Dauphiné-Fortin, has been fined $10,000. The 2 brokers were initially suspended in May 2023 after an article in La Presse exposed their unethical practices. One case highlighted in the article involved a buyer who ended up paying $40,000 more than his initial offer due to a fake bid. In February 2022, a buyer offered $410,000 on a house listed at $399,700 that Girouard was working to sell. Girouard then asked Dauphiné-Fortin to come up with a second bid. Dauphiné-Fortin convinced his then-girlfriend to sign an offer for $370,000, assuring her that the bid would never be accepted. Once the buyer learned a second offer had been made, he increased his bid to $450,000. In June 2022, Girouard and Dauphiné-Fortin attempted a similar scheme involving a bogus offer signed by one of Dauphiné-Fortin's friends. That sale eventually fell through. Girouard was also found guilty of other offenses, including lying to potential buyers in October 2021 about having received a higher offer. She is now facing a second disciplinary hearing this fall for other alleged offenses. In 2 separate decisions, members of the disciplinary committee explained that they decided not to suspend Girouard and Dauphiné-Fortin permanently, in part because they had no previous disciplinary files. However, the committee found their offenses were very serious and warranted heavy sanctions. On Instagram, Girouard lists herself as a coach of successful real estate brokers. The issue of blind bidding, where prospective homebuyers bid on a property without knowing the details of other bids, is a controversial practice in Canada. Critics argue that it contributes to driving up prices during bidding wars. In Quebec, real estate agents are legally prohibited from disclosing details of competing offers. Quebec Solidaire, the province's left-leaning opposition party, has pushed for a ban on blind bidding, but has yet to succeed. Federally, the Liberal government promised during the 2021 election campaign to introduce a home buyer's Bill of Rights that would include a national plan to end blind bidding, but the measure has not materialized. Last December, Ontario adopted new rules that give sellers the option to use an open bidding process. Andrew Harold, a real estate broker with Property.ca, said the measure could help increase transparency for buyers if sellers are inclined to share information about competing bids. Harold mentioned, in a strong seller's market, an open process would keep bidding wars from getting out of hand. He added that it can be very murky and uncomfortable for buyers to compete with almost no information about other bids. However, he cautioned that open bidding would not entirely prevent fraud, as brokers could still submit fake bids to encourage buyers to increase their offers. Harold said, "If somebody wants to be fraudulent, they can be fraudulent and they'll always find a way to get around the rules. It might help, but I do not think it would stamp it out completely." And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussion on the latest developments in the real estate and mortgage markets both informative and engaging. We covered some crucial topics today, from the affordability crisis highlighted by the CMHC housing survey to the recent slowdown in rent growth and the impact of high borrowing costs and record condo completions in Greater Toronto. We also touched on the doubling of mortgage delinquencies in London and the suspension of 2 Quebec real estate brokers for using fake bids to drive up prices. Thanks for tuning in, and I look forward to bringing you more insights in our next episode. Until then, stay informed and make well-informed decisions.